everyone, and thank you for watching my videos. Many investors, after opening positions, find it necessary to add more units to a position that is profiting in order to maximize those profits. Or some investors may find it necessary to close some of the units in a losing position in order to minimize the impact of their losses even when stop loss has not been hit yet. I'm talking about scaling. And scaling, if we do this properly, this concept can give us great benefits as we invest in the Forex market. So let's take this time to learn how scaling works. So scaling just involves either adding more units to a position after it's been opened or taking away units from a position. So any form of modifying the size of our position after it's been opened and before we close. And the benefits is that it becomes easier to exit a position if we need to get out. Because sometimes it's so difficult to close a really big position and to take such a sizable loss. But if we remove small number of units from that position, then the impact of that loss will not be felt hard on your account balance. And also, when we add to the positions to gain those profits, we have to keep in mind that we can lose those profits easily with the market being so volatile. So we have to be careful how we use the concept of scaling, and I want to teach you when to scale and when not to scale. Because the concept of scaling should not be applied all the time. Okay, so here's what we need to know about scaling out. Now, some traders like to lock in profits as quickly as possible in order to minimize an exposure when the market is very volatile. And because the prices, they fluctuate so greatly that some people find it necessary to close the position quickly to get the profits that before they're lost. For example, let's say we decided to short 100,000 units of the euro-dollar pair, meaning we're buying euros and we're selling euros and buying dollars. Excuse me. Now, we enter at the price of $1.30. Our target is $1.27, and we place our stop loss at 131. However, the market moves down to 129, which means we gain 1% or $100 profit. So we decided to lock in some of those profits by buying 5,000 euros in that pair at the rate of $1.29. So this is a great way of guaranteeing that we're going to get at least a $50 profit, even though we've reduced the size of our profitable position. Now, let's talk about scaling in while losing. This is very risky, so if you're a new trader, you don't want to use this method, but if you use your demo account and you've practiced scaling or you've incorporated this into your trading strategy, once you have an idea as to how to use this properly and you're comfortable with scaling, then you can try this method, preferably in your demo account. Now, here are the 3 rules to ensure that we do this properly. A stop is necessary and we must be followed. So we must be able to set a stop loss on one level and we don't change that stop loss. Also, the levels of the position entry, they must be pre-planned before the trade was put on, meaning we don't want to enter a position or make any commitments and then say, what do we do when the market doesn't go our way? So we want to have our game plan set, solid, and placed in stone before we enter. And then also position sizes, they must be pre-calculated, and we have to make sure that we are not going above and beyond our commitment in regards to risk management. For example, if your plan is to risk no more than 3% of your account balance, when we add more units, make sure that you're not going above that 3%. Okay, so here's an example of scaling in while we're losing. So here we have this line graph. Here we have our lines of support and resistance. And let's say right where this green arrow is, we decided that we want to go long because we believe that as the line of resistance has been breached while the market is ranging, that means we might have a bullish trend. However, we were wrong, and the market appears to be continuing its range, and it looks like the line of support has been breached, indicating that the market has gone bearish. And as we can see, that the market appears to have reversed itself a little bit. So, short at the broken support turn resistance level of 1.285 at the bottom of the consolidation level. However, the downside of entering at 1.295 is that the pair may move higher and you could have potentially gotten in at a better price. So again, this is a very risky way of trying to make a profit when the market has gone the opposite way. Now, we can either enter when the market hits 1.285 or 1.295. However, for the stop loss, we keep the stop loss at the same level because we were wrong and we don't want to lose more money than we've already risked. So we definitely got to keep that stop loss right where it was before we begun investing in this position in the first place. Now, let's go back to that graph. So we short at the line of support and we short 5,000 units at the line of resistance. And then we place our stop loss at the $1.31 line. So in total, we've only lost $100, and that is below what we wanted to risk. So again, this is an example of minimizing the impact of your losses. Okay, so let's talk about adding more units to a profitable position. So here's what we need to remember. We need to keep in mind the predetermined levels, and also we need to figure out how much we're risking. Are we going above our limit or below our limit? Because we don't want to go above our limit. And also don't forget to trail stop losses. Move that stop loss level up so we lock in those profits. Okay, so here we have a line graph, and here we have some minor support. And then we decide we're going to go long because we know that this is a bullish trend. So let's go long. But let's determine our stop loss. So we decided to set our stop loss at 1.26, which means that we are risking $100. So let's see what happens. Well, we bought 10K units, or we bought 100,000 units at the level of 1.27, and we set our target at the 1.3 level, giving us a possible profit of $300. So let's do some math here. So we buy our first 100,000 at the 1.27 level, and we close the position at 1.3. That gives us a possible profit of $300. Also, we set our stop loss at 1.26, so we are risking $100. So, however, let's say the market rises to the level of 1.28, and we feel that this bullish trend will continue to be bullish. So here's what we do. We go long on 100,000 more units at 1.28. And by doing this, we also put our target at the same level, 1.3. So if we enter the market at 1.28 with 100,000 more units, set our target in the same place as we did with the first 100,000 units, then we are risking a $200 profit, which in total gives us a $500 profit. Now, let's say we feel that the market is going to continue its bullish trend for a long time. So, at 1.29, we purchase 100,000 more units, giving us a $100 profit. However, I didn't get to the part with stop losses yet, so let's talk about stop losses. We place the stop loss right above above the previous set of 100,000 units. And by doing that, we are minimizing our risk even more. So again, let's say the second order of 100,000 units, we ordered at 100 or at 1.28, and we place our stop loss at 1.27. So we have a stop loss at 1.26, and we have a stop loss at 1.27, which means that reduces our risk from $100 to $0. And we have a third order of 100,000 units, and we do the same thing, but on that order, we place the stop loss at 1.28, and we close all of our positions at 1.3, so when the market does hit that 1.30 level, we gain $600 on that investment, and also with the stop loss, because we trailed our stop loss, we've eliminated our risk completely. So we don't have to worry about losing $100 from our capital. And that's how we use scaling to eliminate our risk, as indicated. And also, when we use stop losses, as we talked about in the previous videos, trail your stop losses so you lock in your profits. Okay, and as we can see, we've hit our target, and that's $600 in our account. Okay, so here's some more information that we need to know. Be aware that adding to winning positions may or may not be the best tool, because if the market has too much fluctuations, we can lose those profits quickly, and those profits become losses. However, scaling into winning positions is also a great way of making money if you are an intraday trader or if you are a swing trader. So again, we're talking about what type of trader you are, because your trading style can determine whether or not scaling works right for you. So keep that in mind. So this all has to do with your trading style and also the systems that you set for yourself and your trading plans that you have for yourself. So also keep that in mind. And another thing about scaling into a winning position is that if you decide to do this in range-bound markets or periods of low liquidity, this can actually hurt you as well, because you actually might hit your stop loss faster. So it's better to use this method when the market is trending, not ranging. And also, we want to be careful of how much margin we use up, because remember, the more margin we use, the closer we get to being margin called. So don't put too much money out in the market. Of course, we want to have a large amount of capital in our account in order to keep us away from being margin called, but the purpose is to have it in there as a cushion so we don't get margin called. So fund your account, but keep those funds in your balance and only use a small amount of capital to open your positions. So that's what we've learned in this, well, not just this video, but also previous videos as well. So again, we're seeing how all the information from my previous videos all come together in this video in order to give us a tremendous advantage in the Forex market. So always use your stop losses, always trail your stops so we lock in the profits, especially if you're going to be an intraday trader, and especially if you're going to sit in front of the computer for 8, 10, 12 hours a day, watching the market like a hawk. So trail your stop losses. Also, only add to losing positions if the risk of your combined positions is within your risk comfort level. We do this so we minimize the impact of our losses so they don't hurt as much. Also, if you decide to add into winning positions, trail the stop losses so our big profits can remain big. And don't forget to calculate. We calculate before we enter, so we know how much we're risking, and we know that if we do lose this amount of money, will this hurt our account? Because the idea is to stay in the game long enough to make those big profits. So it's like this. We lose some investments and we gain on some investments. Sometimes the loss can be bigger. Sometimes we have more losses than gains, but it's all about minimizing the amount of your losses and looking for maximum gains. So again, we want to stay in this market long enough to find the big opportunities. So keep that in mind. And we must take steps before we invest in order to make sure that if this investment is a losing investment, because remember, we can't eliminate losses, but we can minimize the impact of the losses. Minimizing the impact of the losses helps us to study the market, learn more about the market, get the experience that the other great investors have in this market, get past that learning curve so we can get those big profits, so we can achieve our successes faster. And also, one more thing about scaling. When we scale into winning trades, it's also best to apply to trending markets. So try not to scale when the market is ranging, because that's not going to help us get the profits that we need, and it's more likely that our stop losses will be triggered. Thank you for watching this video, and good trading.